Copper prices just hit a record high, all because of one sentence from Donald Trump. We're doing copper, 50%. In minutes, copper futures in New York exploded to $5.95 per pound, a price the market had never seen before. That's a 13% jump in a single session, the sharpest rise in copper's trading history. The U.S. price now trades 25% higher than London's, opening up a never-before-seen arbitrage gap. And that shock puts Canada's $9.3 billion copper export lifeline in serious danger. Why? Because Canadian copper often moves from Quebec to Asian smelters, then returns as refined metal to American factories. With this new tariff, Canada has a tough choice: absorb the extra cost or cut the U.S. out of the copper loop entirely. Either way, the entire North American copper supply chain could be redrawn overnight. Over the next 14 minutes, we'll break down Trump's pressure-first, deal-later approach, and how Canada may fight back. Then we'll ask the question Washington fears. Are American voters ready to pay for a trade war every time they buy a car or flip a light switch? Just hours after markets closed on July 10th, Trump signed a Section 232 proclamation. The new rule is a 50% tariff on every pound of imported copper starting August 1st. The White House claims it's about national security, but the fine print reveals something else. In 2024, the United States imported 810,000 tons of refined copper, meaning half of what powers American factories will now be taxed the same way luxury imports are. The proclamation also extends the negotiation deadline from July 9th to August 1st. This gives Ottawa, Brussels, and Beijing just 3 weeks to strike side deals or get hit with the full tariff. That may sound like extra time, but trade lawyers say it's the same old game. Apply pressure first, negotiate later. Even before the copper bombshell, the U.S. average import duty had already reached 16%, its highest level since the Great Depression. Now, with copper added in, the International Chamber of Commerce warns tariffs could top 20%, a level not seen in 90 years. Markets didn't wait. On July 8th, COMEX copper futures surged over 12% to an all-time high of $12,330 per metric ton, as traders rushed to price in the tariff. Shares of Freeport-McMoRan rose slightly. But over in Toronto, the S&P/TSX Materials Index fell, showing how this copper war is shaking miners across the U.S.-Canada border. Canada refines around 25% of the copper the U.S. imports, so it felt the tremors first. Prime Minister Mark Carney promised to protect Canadian workers and businesses with legal and diplomatic tools, possibly even WTO action or retaliation. At the same time, Ottawa is reaching out to Asian smelters to reroute Canadian exports. The private sector is already acting. Teck Resources has booked new warehouse and port space to ship copper directly to Asia, cutting the U.S. out completely. CEO Jonathan Price says they activated this plan the moment Trump reinstated aluminum tariffs back in March. In short, this 50% copper tariff isn't just political noise. It's a massive protectionist strike that could reshape the North American trade network overnight and push U.S. average tariffs to Hoover-era levels. Next, we'll look at how these copper costs ripple through electric vehicle production, power grid upgrades, even ammunition supplies, and why Canada's response might reshape global trade for years to come. Container lines stack up overnight, and warehouses in New Orleans report a sharp 40% surge in inbound copper cathodes. Meanwhile, LME stockpiles continue to shrink as metal rushes toward the more expensive U.S. contract. But, the real pressure builds downstream. Electric vehicles, on average, consume up to 80 kilograms of copper, nearly 4 times more than gasoline-powered cars. This means that for every 5-cent increase per pound, automakers like Tesla see about $90 added to each EV's material cost. Scale that across Tesla's Fremont factory, and you're talking millions of extra dollars each month, before a single car even leaves the lot. Ford is also bracing for impact. Their procurement team has already warned suppliers price pass-throughs may start appearing in August invoices, and the timing couldn't be worse. As back-to-school shopping hits full swing, utility companies are also feeling the heat. Every mile of high-voltage transmission line eats up nearly 5 tons of copper. With prices spiking, the cost of Biden-era grid upgrades is climbing by hundreds of millions, forcing utilities to either delay projects or request emergency rate hikes from regulators. Canada, right in the blast zone of this trade war, is already making moves to dodge the choke point. Teck Resources is fast-tracking a plan to ship raw copper concentrates directly to South Korean smelters, then hedge the refined metal on the Shanghai Futures Exchange, essentially cutting the U.S. out of the supply chain. Canada's trade minister told Parliament that all options are on the table, including retaliation and WTO action. But insiders say the faster solution is to divert exports to Asia, not fight Washington head-on. Meanwhile, Wall Street analysts are modeling worst-case outcomes. UBS estimates that if the copper premium stays above $1,000 per ton through September, U.S. manufacturers could be stuck with an extra $4.2 billion in costs this quarter alone. That added expense might shave half a percentage point off fourth-quarter GDP. In simple terms, the tariff designed to protect U.S. supply could end up exporting both metal and economic growth, leaving American factories with the bill while Canada shifts its copper trade toward Asia. Ironically, Canada thought it had bought peace on June 30th, when Prime Minister Mark Carney canceled Ottawa's planned 3% digital services tax. That tax was expected to bring in nearly $6 billion Canadian dollars over 5 years, but Canada scrapped it at the last minute, trying to restart those stalled trade negotiations with Washington and meet the July 21st deadline for a new trade deal. The White House agreed to the concession, but then struck back anyway. On July 8th, the same officials who praised Carney's decision announced a 50% duty on copper. They also threatened a 200% tariff on pharmaceuticals if Canada doesn't sign a deal before time runs out. That move, well, it really hits where it hurts. Canada is the second largest supplier of refined copper to the United States, making up 17% of imports last year, according to USGS data. And, much of that metal starts its journey thousands of miles away. British Columbia sends over half of its mined copper to Asia, mostly China, Japan, and South Korea, before it comes back to North America as cathodes for U.S. factories. By targeting copper that loops through Asia, this tariff clogs up nearly every link in the North American supply chain. Auto industry experts say that each electric vehicle still needs up to 80 kilograms of copper, and with Trump's new levy, the copper surcharge per car jumps to about $220 at today's prices. The problem? There's just no domestic source ready to fill the gap. Canada's first move is speed, not saber-rattling. Teck Resources is already redirecting copper concentrate to South Korean smelters, who can then resell it into China. At the same time, provincial officials from Quebec are flying to Lima and Santiago to line up new buyers in case U.S. borders slam shut. Behind closed doors, industry lobbyists hint that Canada may even suspend export permit fees, effectively subsidizing miners to sell eastward, keeping the mines running and avoiding a labor crisis. Carney's team insists retaliation is still an option, but diplomats admit that WTO litigation could drag on for years, much longer than it will take for these tariffs to hit construction projects, data centers, and power grid upgrades. In short, Canada is stuck in the middle of Trump's protectionist storm, too entangled with the United States to break free, but too vulnerable to stand still. Now it's a race against the clock to pivot Canada's $9 billion copper pipeline toward Asia before Washington's next trade threat becomes reality. Canada's pivot is no longer just talk. It's happening right now. On March 31st, Statistics Canada reported something that, really shook up trade watchers. Exports to countries other than the United States surged by nearly 25%, while sales to the U.S. dropped by 6.6%. That's the biggest gap in almost a decade. And honestly, it redraws North America's trade map overnight. And it's not just about numbers. Consumers are feeling it too. In Montreal, a Global News Street poll aired on March 6th showed shoppers promising to boycott American products, reviving the same Buy Canada chant we last heard during the 2018 metals war. Investors have noticed this shift as well. At 6:25 a.m. Eastern on July 10th, S&P futures opened in the green, driven by rumors of an ASA free trade deal, which could open new routes for Canadian copper and grain exports. But Ottawa still has a powerful card to play. Mark Carney's tariff list keeps 125 billion Canadian dollars worth of U.S. imports on standby, ready to face new duties at 12:01 a.m. on July 22nd, unless Washington agrees to remove its 50% copper tariff. In simple terms, Canada is building a backup supply chain before the deadline hits, and if the clock runs out, Bay Street analysts estimate U.S. exporters could take a 4% hit on all goods sold to Canada. Let's break down what that looks like. On March 31st, the real price shock began. Reuters reported that Cox Automotive has already warned dealers. A car made in Windsor or Monterey will now cost $6,000 more, thanks to the copper duty plus the ongoing steel and aluminum tariffs. Even a Detroit-built pickup truck is getting hit. $3,000 more per vehicle. And you know, it doesn't stop with cars. Home buyers are feeling the pinch. According to CoreLogic's February report, the tariffs on metals and lumber are adding $17,000 to $22,000 to the cost of building a new house. That's enough to wipe out the entire down payment for many first-time homebuyers. The National Association of Home Builders backs this up. Their May 1st survey says the extra material costs now total $10,900 per single-family home, and that's just 4 months into this tariff battle. The result? New construction projects are stalling from Arizona to Ohio. When you add it all up, the average American consumer is now paying for this trade fight, both on four wheels and four walls. JP Morgan's analysts warn if copper prices stay above $12,000 per ton through September, the damage to the auto and housing sectors could cut 0.5 percentage point off fourth quarter GDP. That's the growing bill hanging over the economy, and it's getting worse as Canada works quickly to shift its trade routes toward Asia and the Middle East. Now it all comes down to the calendar. If Ottawa pulls the trigger on its 125 billion Canadian dollar counter tariffs at 12:01 a.m. on July 22nd, the trade war will explode from metals to medicines, from grid wires to smartphone components. But the White House still holds the off switch. So what will Washington do? Back down to avoid inflation and broken alliances? Or double down and bet that voters will pay the price for security? The next 10 days will decide whether we repeat a 1930s-style tariff wall or find a modern deal that keeps copper, cars, and credibility moving. What do you think will happen? Will it be a last-minute handshake or a full-blown trade showdown? Drop your prediction in the comments. Your comment could be tomorrow's headline.